Hey guys, welcome back on the Blockworks Macro YouTube channel. Alf speaking, and Jack is here with me. He needs no introduction, very well known in the Blockworks family, and I guess on YouTube by now. Jack is a star. How are you doing, man?
I'm doing well, Alf. Great to be here. Great to catch up with you. There's a lot going on in macro, and there's a lot going on in crypto.
Yes, pretty much. So today, I guess it's about time to start talking about inflation to start with, because we're recording on, 10th of November, 2022. We just had the CPI release. And can you summarize for the audience what actually happened in that CPI release?
Yes. So the CPI for October increased by 7.7% for October 2022 relative to October 2021. So that's a yearly increase. And the what was anticipated by economists, and Alf, we all know that economists have an impeccable track record, they're never wrong, was 7.9% or 8%. So it was 20 to 30 basis points lower than economists had expected. So we are seeing essentially an everything rally. Just to be clear, for one day, the long-term bonds are rallying hard, so their yields are collapsing. But in particular, short-term bills, those yields are falling as well. The Fed terminal rate is now below 5%. And actually, I think an ETF, which is basically short-term treasuries, SHY, is rallying the hardest it did since September 29th, 2008, when the stock market crashed, I think something like 8%. So this time the stock market's up 4%, and NASDAQ and S&P are having their best days best days since March 2020. And of course, March 2020, bad month for stocks, but there were days where you had huge rallies. And ARKK, is having the best day ever. And by the way, we're recording this at 12:55 p.m. So basically 1 p.m. So, the market closes in 3 hours. So anything could change. But pretty wild day.
Yes, very impressive. I mean, when I look at the CPI report, we had core inflation printing at 0.27% month on month. This is the lowest month on month print in core inflation since summer 2021. It's been a while since inflation only printed at 0.27% in core terms month on month. And that's what the Fed cares about, right? They care about the trend of monthly core inflation prints because, oil, food, they can be volatile, but core services prices is really what they care about right now. And they got what they wanted to a certain extent. If I look at the moving average, the momentum of this core inflation over the last 3 months, we're looking at roughly 0.5%, which is much more elevated because this has been the first week print. So if you look at on a trending basis, but it's slowly converging towards something remotely acceptable for the Federal Reserve, at least if this trend has to continue all the way through 2023. The bond market reaction was incredible. So I think actually pictures speak louder than words in this case. So I want to share with the audience here what I see on my screen. This is a volatility adjusted dashboard for interest rates. And this is the bond market in the US. How this dashboard works is the following. The darker the color in the daily change, the biggest the volatility adjusted move. So dark red means it moved a lot on the way up. Dark green means moved really a lot on the way down. Dark green means 3 standard deviation or more. So we're talking about a really remote event, right? And look at it, it's full of dark green over here. And precisely there are 3 things to notice. The first is, and you were correct, that front-end bond yields dropped very aggressively. But in a volatility adjusted terms, Jack, the entire curve actually rallied very aggressively. Now, the front end rallied more than the back end, and that's reflected in the curve slopes. So when you see nominal curves here, you're looking at various slopes, 2s5s, 2s10s, 510s, 530s. And 530s, so the slope between 30-year yields and 5-year yields in the US actually steepened by 13 basis points in a single day, which is a very, very aggressive move, which means the front end actually led the rally on the way down. And you can see it as well in terminal rate that you have already highlighted, where 6 month forward, 1 month. So this is the terminal rate. It's the highest point price in the hiking cycle of the Fed, actually rallied from roughly 505% to 484. And a 20 basis point move in this series is actually very, very large in volatility adjusted terms. And Jack, the other thing to notice here is that volatility in the bond market is getting completely crushed. So these are swaption volatilities, which sounds very complicated, but it's nothing else than the implied volatility in swaps. So think of it like what the market is pricing in terms of volatility to come for yields. So a 1 year, 2 year swaption volatility will be the implied volatility for 2-year rates next year, effectively. That's what it is. And this volatility is pretty high at 130 basis point annualized, but it has come down today very aggressively. And why is that? Because once inflation starts getting lower, the volatility around the Fed reaction function actually becomes lower as well. So markets can price in a lower volatility in the bond market.
Yeah, so a few things, Alf, just for our American viewers. Commas mean basically points. So when it says the 2-year went down 25,8, that means 25.8 basis points. Green means it just rallies, and that's it. You see a lot of dark green and a lot of dark red on this chart. And Alf, having been lucky enough to see your dashboard before, I know that dark green and dark red is very rare. So this is, normally we're seeing those light green, light red colors. So this is an extreme day. I did notice that about the steepening between the 30-year and the 5-year.
Here.
And particularly just the relative weakness, again, strange to say on such a great day for bonds, but the relative weakness of long-term bonds like TLT is only up something like 2%. It's like even on the best day for bonds ever, TLT is still sort of lagging behind sort of the other interest rates. And also for volatility, that is very interesting. I did not know that at all. Some folks may know that often implied volatility is depends heavily on realized volatility of the past. So for example, if recent realized volatility has been low and S&P has just been flatlining and just not really moving at all, that implied volatility will be low. If you have something like March 2020, where it's up 5%, down 8%, up 9%, then the VIX will be at something like 80. Implied volatility will be high. But sometimes you have things where realized volatility is very high, but that actually leads to a collapse in implied volatility because there's this something like, like the market takes a deep breath and say, we figured this out. There's now like the path is more certain. And for example, you see that in earnings when, Snapchat collapsed 25%, but actually volatility collapsed because the thing that was going to cause it to move already happened. So it's like you're getting this market sort of thinking that it knows what's going to happen, although it may not.
That's correct, Jack. And this reading of a more predictable Fed path ahead of us with less uncertainty, basically, after this core inflation print lower, is reflected not only in lower bond volatility here, but also in credit spreads. I mean, high yield credit spreads and investment grade credit spreads compressed pretty aggressively today. So those are corporate credit spreads in investment grade through sectors and in high yield through sectors. And you can see that the high yield 5-year credit default swap composite actually compressed very aggressively, which means the credit spread was priced basically to tighten, and credit risk is basically perceived to be lower today after the inflation print. As the economy magically improved, not really, but what we are pricing in, Jack, is that the Fed will be less aggressive and therefore less likely to put a lot of pressure on these highly leveraged companies.
Right, but Alpha, why did inflation fall? It fell because used car and trucks is down 2.3%. Month over month. Why is used car prices falling? Because we're headed for a steep recession, and that's not exactly one where you want to be short credit default swaps.
Yeah, so that's an interesting story because we haven't talked about why did inflation drop, Jack, right? I mean, we have chatted about the bond market reaction and looked a little bit into the derivatives market as well. But inflation actually dropped not because the sticky core services prices are lower. It's going to take a while for them actually to come down, but because finally core goods are taking a solid hit, which was to be expected because, these forward-looking indicators of good prices like used cars were rumored to be already very weak. And finally, it's now reflected in the inflation basket as well. But will the Fed take comfort by the fact that car prices are falling? I mean, you already saw a slew of Fed speakers coming to the wire after the release. And, you understand that they don't want to make the same mistake that Volcker did, despite it was very successful. One of the first mistakes he did is to ease the fight against inflation too early, which then led him to be much more aggressive later on, as a second cycle in inflation higher forced him to raise rates all the way to 15% plus. Now, Powell considers Volcker to be his hero, and he keeps repeating, we will keep at it, and keeping at it is the name of Volcker's book. Mm-hmm. That's not a coincidence. Now, of course, a rally like this is justified as well by market positioning and by the fact that we are going towards the end of the year, where if you are, short bonds and you have been making money the entire year, it's about bonus time, Jack. I mean, I've been there a lot of times in my career. And if you had a good year until October, November, because you were short bonds, because you were short stocks, and then you get a report like this, the only thing you care about is to hedge your risks. And your risks at that point is that the bond market rallies and the equity market rallies so hard and you are short, your performance goes down and your bonus is gone all of a sudden. So what you are going to do is you're going to behave very institutional, basically, and buy call options. The skew in these equity market options is incredible, where people are paying for the upside optionality, not necessarily because they believe there's going to be a massive equity rally, but because they want to hedge their bets against a market rally at the end of the year that will wipe out their bonus and their performance this year. So there is a bit of positioning, a bit of institutional behavior and seasonality that actually, I think, complements and enhances this market reaction we have seen so far.
I don't know exactly about the time horizon, but after the CPI report was released, Nick Timmeros, friend of Forward Guidance, he put out an article saying that the Fed is likely to be on the path to hike by 50 basis points in December instead of 75 basis points. Before it was priced at roughly 50-50. So now, the rates in December will be 450 instead of 475. And that is related. Now, did that cause the bond market mega rally, or did the mega rally cause that? Who knows? We're not really in the causation game, but that's definitely something to pay attention to. I do think that the pivot, people who are claiming, I knew the Fed was going to pivot on Twitter, that it may be a little premature. A pivot is when they stop hiking, they go from hiking to stopping hiking. It's not when they go from hiking 75 to hiking 50. And the terminal rate is literally, even though the terminal rate has collapsed from like 520 to 490 roughly, it's still where it was literally a week and a half ago, but 2 weeks ago, before the FOMC meeting at the beginning of this month. So it's too early to declare victory for the pivotistas to declare victory. That's my hot take for this episode.
Yeah, I mean, I think you're right also because there is another CPI print between now and the Fed meeting. It's a December CPI print. There are labor market data as well. It's not going to be a smooth move down. I do expect inflation to actually print below 2% by the end of next year. I do expect a sharp move down in inflation because you mentioned it before. We are so far talking about inflation, but what about growth? We are looking into a pretty serious recession, I think, as a base case in 2023. And if you look over the last 100 years, as a study I've done in the US, every single recession over the last 100 years, when the US entered the recession with inflation way above 2%, US exited the recession with inflation at least at 2%, and in any case, 7 percentage points below the peak pre-recession. So a recession does slow inflation down, 100% hit rate the whole time, and very significantly so, for obvious reasons, Jack, because people lose their job, their spending power goes down, their wage demands can be higher if the labor market becomes weak all of a sudden, and you start to understand where we all go, where the demand side of the equation slows down dramatically, and therefore commodities slow down and prices slow down as well, and you actually get this slowdown in inflation. It takes on average 16 months over the last 100 years in the US in recessionary episodes to slow inflation down from the peak to 2%. So if we would be roughly looking into a recession today, we would get an average one. Given we are at 7.5%, one could expect the serious recession would be able by the end of next year to already slow down inflation to roughly 2% or maybe 2 to 2.5%. Now, the issue is that it's difficult to be bullish in a recession. And people don't appreciate that. They look at, the Fed is going to pivot. In 2001, the Fed cut interest rates from 6.5% to something like 2.5%, 400 basis points in a single year. That's a pivot. That's a serious pivot. Do you know what the equity market did in the first 3 months of the year? The S&P 500 dropped 12%, while the Fed cut 150 basis points in 3 months. So every meeting was 50 down, 50 down, 50 down, a proper pivot. Yet the dollar appreciated and the S&P 500 dropped another 12%. Why? Because people were getting unemployed, Jack, because earnings were dropping like a stone, because animal spirits can't be restored if people are losing their jobs. And from a retail perspective, flows are actually on the selling side, because this year we haven't seen any retail flow capitulation yet. We have seen institutional investors being burned, being stopped out, being very light as well in their allocation today, reflected in the skew we discussed before. But we haven't seen a capitulation from the retail crowd because the job market is very strong. There is no reason to want to raise cash if you're doing okay from a job perspective. When the retail flows come next year and earnings slow down, they are already, by the way, and the labor market slows down as well, how can you be bullish? That's not a pivot to be bullish about. You can be bullish once the Federal Reserve has become accommodative. So that was back then in 2002 when the equity market bottomed, also because earnings were bottoming back then. But we are far away from earnings bottoming, in my opinion.
Yes, the rate of earnings growth is pretty close to zero. It's like mildly above zero. If you include energy, it's way down from last year. If you take energy out of the picture, then earnings is pretty close to zero. Your earnings growth is not earnings is zero, but earnings growth is close to zero. Yeah, I mean, Alf, I totally agree. Just a little fact I always like is that the equity risk premium was actually, I think, negative in 2000, meaning that people were paying more for the future cash flows of equities than they were for literally like the 10-year treasury note, which is kind of ridiculous because treasury notes are way safer. And that always challenges the narrative of, oh, everything's about the discount rate. And when yields are low, that's like a great time to buy Tesla. And when yields are high, it's a great time to buy a really short duration equity. But that aside, Alf, I'm sort of just the crisis within crypto is making me quite bearish, to be honest. I'm so bearish. I'm literally I'm getting lost walking around the city that I've lived in my entire life. I'm walking down the wrong streets because I just keep just churning. Like I should be, I should go to a river and start trying to grab salmon with my hands. That's how bearish I am. But here, Alf, is just a tail risk scenario. That's definitely not my base case. Everyone at home, relax. Don't worry. I don't mean to get you too worked up, but the price of oil, energy, natural gas has been falling since the late spring, early summer. That has been a disinflationary force. On a month-over-month basis, a literally deflationary force.
Correct.
A lot of that has been because the Chinese economy is shut down because of COVID, and because the U.S. government has been releasing barrels of oil from its strategic petroleum reserve. There are rumors, which I don't believe. I actually think most likely these rumors are false, but that the Chinese economy is going to reopen. If that happens, demand will spike. 2 million barrels will spike. And then if we just had the election where Democrats did quite well, we did not have the red wave of Republican red waves. Some people saying, the reason that the U.S. government was releasing it from the Strategic Petroleum Reserve was so inflation would be low, because that would be good for elections. If that thing stopped, you could have two catalysts that could propel the price of oil higher. Right. It's November 10th. CPI measures, I think, November 1st to November 30th. I forget if there's a 31st day in the month of November. So things would have to go pretty quickly. Oh, also, our friend Andreas Stena Larsen has absolutely nailed why natural gas would fall sharply over the summer. It's a warm fall, oddly warm fall. There's way too many liquefied natural gas ships. There's not enough plants. The price could go negative on an intraday basis. I mean, he absolutely nailed it. He's now saying, the winter's coming. So that, and if that happens, the Federal Reserve is already committed to 50 basis points from Nick Timiraos. I find it very unlikely that they'll go back to 75. So what would they have to do? They might have to commit to, we're doing 50 this time, but we're going to do 50 next time and a 50 after that. So a terminal rate of, at the very least, 5.50%. Is that good for stocks? Is that good for crypto? I don't think so. So Alf, talk about that, or I know we today's going to be a short episode, so we can delve right into crypto. But where do you want to go from here?
Jack, breathe, my friend. It's so good. It's so good. You will see many more market cycles like this. It's complicated, but at the end of the day, as long as you have a strategy, systematic approach, a data-driven approach, you'll be fine. So when it comes to this commodity cycle mini cycle you're talking about, it's a very interesting point. And I also think that, a divided government in the US will have a much harder time selling oil from SPR. Yes, Biden can do that unilaterally. That's correct. But you're going to be deploying a lot of political capital. You have to go through the 2024 elections. You can't be a dictator and, do things unilaterally the whole time. It doesn't work like that in politics. So I think on the margin, it's a bit more complicated now to use the SPR. as a way to put oil prices down. And if China would really reopen, then there would be a strong catalyst for any commodity out there, actually, copper and aluminum and oil, et cetera, et cetera. Now, again, we're talking about a couple of ifs, right? I mean, China reopening has been already dispelled a couple of times as a trade, and it's impossible to predict, to be honest. I mean, you have to be friends with Xi Jinping, which I am not, and I don't know if you are, but I don't know the guy. So I don't have any material information there, but it's something really to keep an eye on. When it comes to rates, there's one thing I'd like to point out. However we slice and dice it, because of the reaction function of the Fed and because of the calculation of core inflation, basically, it is almost impossible that Fed funds rate will be anywhere lower than 4.5% to 5% all the way through at least mid of next year.
100%.
That's a long way to go with risk-free rates at 4.5%, 5%. We're talking about the US. When I chat about Europe, in the 90s, Europe, to slow down inflation, there was no Europe back then, but let's say France, to take the barometer of a European country, France had inflation at 4% for 3 years in a row, between 89 and 91. Neutral rates, under my estimate in France back then, were around 4.5%. Do you know to which level of rates the Banque de France had to raise rates to slay the inflation dragon? 9%, 8.5% to 9%. And it had to keep them there for 2 years. Then inflation slowed down. So it takes a while, actually, to have the effect of tightening financial conditions into the economy through higher interest rates. There is a lagged effect, right? And that's what also the Fed has told us. It will take a while to slow inflation down. And if today neutral rates in the US have been roughly estimated, nobody knows what they are, but roughly in the 2.5% to 3% area, it is completely foreseeable that rates should have actually to stay around 5% for a good period of time until you start to see the damage in the real economy that literally brings inflation down. So a commodity rally could only complicate the situation for any central banker right now, because there is already enough pain going through. They'll probably need to double up on that. A word on crypto, I think, because it's an interesting topic. I just tweeted something. People should really pay attention to this. When you talk about your money, Jack, and you think about the safety of your money. Now, of course, very sorry for people that are involved, having deposited money through FTX. And a lot of institutional investors have lost a lot of money too. I just tweeted this morning that the Ontario Teachers Pension Plan, again, Teachers Pension Plan, actually backed the FTX Series A and B rounds, if I'm not mistaken, and invested roughly a couple of $100 million in there at valuations anywhere between $8 and $25 billion. And it's now roughly worth zero, basically, right?
It's worth zero, and the biggest crypto exchange in the world had the chance to buy it for $1, and it refused. So it's worth less than $1.
There you go. So institutional investors lost money too. BlackRock as well was in that serious funding too. So it's not only retail people at home, but also institutional investors lost money there. When it comes to depositing money somewhere, so having your money as a deposit somewhere, I always tell people that to evaluate the safety, the credit risk embedded into that form of money, the easiest question is to ask yourself, whose liability is that money? So the easiest form of money today, or the most common, is a bank deposit. So a bank deposit at Wells Fargo or Chase in the US for anything less than $250,000 is effectively implicitly a risk on the US government. Through the FDIC insurance, you are basically ensure that that kind of money, even if the bank goes belly up, gets backed up by the government of the United States. Anything that you invest in T-bills, in treasuries, in short-dated treasuries is also a liability of the government, and something very liquid that you can quickly exchange for cash. Especially T-bills are very little interest rate risk.
And no limit on that. You could have $10 billion in treasury bills. Doesn't matter. It's safe.
Correct. Safe. It's a credit of the U.S. government, which by the design of our system is safe by definition. There is
you have interest rate risk, but credit risk, while not zero, is the lowest credit risk of anything in the world
that you can have. And we can make a separate podcast episode on talking about the forms of money. But stick with me for another minute. So you have bank deposits below 250,000 and T-bills. Those are, in our monetary system, fiat system, the closest to a risk-free thing you can ever get as a form of money. Then you have bank deposits above $250,000. And there, Jack, you have a risk of a commercial bank, unsecured risk liability of a commercial bank. So if the bank goes belly up, anything above $250,000, I'm sorry, but you are running credit risk on a bank. Okay, so it's more risky, right, than a normal smaller deposit or an investment in treasuries. When you're leaving money on an exchange, FTX, you don't have FDIC. Your money is the liability of FTX. So I want people to think about that and ask themselves, whose liability is my money, when they think about the safety and the credit risk embedded in their forms of deposits. And this was, unfortunately, a tough lesson from that perspective, but I hope it helps people think about money in the way they should think about money. Money is not yours. Money in a credit-based system like ours is a liability of somebody else, often of the commercial banking sector or of the government. So you should always think about whose liability is my money when you think about how safe really my money is. I hope I'm explaining myself.
You're doing a great job of explaining yourself, Alf. I couldn't agree more. The word deposit is thrown around, but in my opinion, deposit means that it's safe. And if you're depositing money that you won't get back because the institution with which you placed your deposit goes insolvent, that's not a deposit, that's a loan. And those loans go bad. In the case of Celsius, a crypto lender that in terms of its marketing, it was not at all upfront. They used I don't know if they use the word deposit, but they're like, oh, it's safe, it's safe. But actually in the legalese language, if you read the contracts, and I know, 99% of people, including myself, like do not read contracts frequently, but it did say that it did constitute a loan. I'm not aware of FTX. The up in what a week ago was the second largest crypto exchange in the world. And I just cannot say how shocking this is, Alf. I think this is like, Monday is going to be the day on which this happened. Tuesday, Monday, it was different than Wednesday. Like it is a pivotal market in crypto. But yeah, I mean, people who had funds, and there was an immense amount of people who had assets say, oh yeah, I've done great. I bought Bitcoin at $1,500, and yeah, it went up to $70,000. I was doing great. Now I'm not doing as good. It's only at $20,000, but I'm still up, many multiples of my investment. That's gone. I mean, they may get that back in a bankruptcy court, but if they wanted to get it today, they cannot get anything for it.
Yes, it's really bad, and it's a bad story, Jack. And with my explanation about money, and I've written extensively as well about what money is and how it's created and whose liability it is. I hope that it helps people thinking through what forms of money do they own, whose liability is their money. That was it, really. And again, I'm very sorry for the episode. It's a big one, actually. It's an Enron moment for the crypto industry, basically.
It's an Enron. It's a Lehman. It's huge. Honestly, FTX was way bigger, way more important to crypto world than Lehman Brothers was to the financial system. I mean, it's like Goldman Sachs or JP Morgan fall down, not Lehman Brothers, which was, maybe the fourth or fifth biggest bank, but not number one or two. This was the second biggest one. And the first biggest one had the chance to buy it for $1 and said, no, things are so bad that I'm not going to buy it for $1. So I think there are a lot of AMMs, like automated market makers, who provide liquidity, who had funds set up with FTX. I mean, I think the financial, this is just my opinion, not investment advice, but I think on the short term, the financial contagion within crypto will be immense. That's just my own personal view. I think the contagion beyond crypto, I actually think could be quite contained. Like, yes, if crypto crashes, I'm just going to guess the S&P probably won't do so well that day. But in terms of the economic contagion, like, yes, like, NVIDIA produces a lot of chips, and those chips may be less valuable because it's not, no one wants to buy mining rigs to mine Bitcoin. But like JP Morgan does not really have exposure to FTX. I think there are some banks, I'm not going to name names because I don't want to like cause any fears. People should Google crypto bank stocks, and they can find out what they are, that do have some exposure. But I think financial contagion outside of crypto, beyond crypto, within TradFi, will be limited on a fundamental basis. On an intraday basis, everything swings around all the time. But those are my thoughts. What do you think, Alf?
I think you're right, Jack. The crypto ecosystem can't be considered the same when what was considered to be the golden standard, almost golden standard, actually goes belly up rapidly. It's definitely not good. It also discourages big times an institutional flow into the space, which I'm not sure would be a necessarily positive thing for Bitcoin, or the crypto area. But now you're pretty sure that after such a large liquidation event, there will be no major institutional flow incoming into the business for a while. So it is quite an important moment for crypto when it comes to contagion effects elsewhere. You said it. I mean, the crypto universe already shrunk by about $1 trillion something this year. So it had become systemically less important by definition because of its size and market cap shrinking. And also the institutional involvement and the contagion effect had been relatively limited because, the adoption and involvement of institutions was relatively low. So I don't think you're going to see massive long-term repercussions when it comes to cross assets there. I tend to agree with you from that perspective.
Alf, I know we're running a little bit low on time. I know you have a really important announcement about the Macro Compass. Everyone knows you, Alf. You've got now over 300,000 followers on Twitter. You've got many, many tens of thousands of subscribers to the Macro Compass, but which is your newsletter, which is currently for free. But I know that you're taking the Macro Compass to the next level, and I want to hear all about it.
So I'm basically graduating Jack, the Macro Compass, from one of the biggest macro newsletters out there to a holistic, all-round macro platform. Because the truth is, I had the luxury to be a pro institutional investor for quite a long time, and you get access to an amazing level of knowledge, information, data, tools, etc., that people don't get access to, and that's pretty unfair. So I took the leap of faith of dropping that industry and sharing my knowledge so far through the newsletter. But the newsletter is not enough to actually deliver and close the gap that people have compared to financial institutions. Basically, to step up the game, I'm now moving the Macro Compass, or graduating the Macro Compass, from a newsletter to a top macro platform. And effectively, there will be a journey that I want to bring people towards that will have three main features: educational, interactive, and actionable. So it will encompass anything from reports, courses covering every angle of the monetary plumbing, monetary mechanics, functioning of asset classes, portfolio management, risk management. There will be interactive tools, and that's something I really am proud of, trying to close the data and the macro access to data gap between people and institutions. These people can sign up easily to very expensive services that you all know of that give you an edge and access to data. And I want to close that gap, make that available to you. That dashboard you saw before on the screen, basically, it's going to be interactive, usable, chartable for people to test trade ideas, chart stuff, look at data, cross-asset market moves, standardized by volatility. All that nice stuff will be made available for people. And obviously will be actionable. There will be model ETF portfolio, tactical trade ideas, the whole bunch. The free newsletter will remain there. It doesn't go away, but the Macro Compass platform will just be a total step up in the macro game. And effectively, I'm launching the products already, announcing the products today. The product will go live in January, but obviously there is a discount code, an early bird, if you want to sign up already. You can use the code ALF. It's pretty simple, ALF. You get 10% off from any products you choose to go with on themacrocompass.com. That's the website.
Oh, wow. That's really exciting. So the free newsletter stays, but there are additional reports which will be paid. There's additional courses which will be paid. And then there's a data platform as well as pro to pro, so people can sort of pick your brain. And will this be one single thing where they can sign up, or there's different differentials of tiers, or tell us how it's going?
There are two tiers for retail people, or sophisticated retail people as well, and one tier for one product for pro investors. So the retail people can choose between having, let's say, a cheaper version where they have a weekly report, they have an ETF only model portfolio they can easily replicate and look at as an inspiration for their own management and investment process. And they will have 25% discount on macro courses. That's the lower, the cheaper tier, let's say. And then there is a bit more expensive one, but where you get a bunch more things, including these macro tools, databases, interactive macro tools that you can use basically and get access to this data I was talking about before. You get much more content, much more timely, especially around Fed meetings, ECB meetings, job market reports, especially when there's a big market move. You'll get tactical trade ideas on top of the portfolio. You'll get a 50% discount on all macro courses I'll deliver. It's a much more comprehensive package. And that's a second package for retail investors. And then if you're a pro institutional investor already, there will be a completely separate treatment, bespoke products to accommodate the demands of institutional investors, which are different than the ones from of a retail investor effectively.
There we go, Alf. From the first time I read your first report which I believe was sent to me by a mutual friend who said, do you want to interview this guy? I made the decision that it was a yes, probably within about 10 seconds of reading your report. And, I always knew you were fantastic. The level of insight that you have and your ability to communicate it to a broad audience is unparalleled. And I look forward to the next chapter in Macro Alf and the Macro Compass.
Thanks, Jack. All this is about really is trying to close the gap of knowledge and access to information between financial institutions and pro, where I was before, this ivory tower, effectively, of reserved knowledge and reserves access to data, and totally close the gap between that and what we get from this side of the fence, where I am now, which is the retail side of the fence for most cases. And it's just unfair that people don't have the same access to data, knowledge, and just step up their macro game. I think that is the aim of what I'm trying to do, and I hope I'll at least be partially successful. They'll make me happy already.
So we got tier for retail, tier for sophisticated retail, tier for institutional tier, and all these go up in price. Is there any tier where, no matter the price, where we can get on a call and you can say either one of the following? It's okay to drink coffee with milk in the afternoon, or that bank reserves are money? So
coffee in the afternoon, it's going to cost $1 million a year. Can't accept for anything else. Or a cappuccino in the afternoon, actually. That's even more expensive as a subscription. And bank reserves are money. Yeah, they're money for banks, so they're not really money for us. If you want to say that or want me to say that there's no price. Because
no MasterCard price. Is priceless.
All right. Can't compromise on that.
Wonderful. Well, Alf, thanks so much for having me. It's been a pleasure to be on Boiler Room.
Thanks, Jack. A pleasure to have you.